Hello everyone. This video lecture covers objective 6 and 7. It's a very short. It's a very short video lecture because of it doesn't actually have a lot of slides and techniques here. So objective 6 talks about costs that are irrelevant for decision making. So the idea in this objective 6 is the managers very often need to decide how to do the business. How to do business, especially when the manager is overwhelmed with many different kinds of costs. So, for example, there are thousands of costs in the decision making. The manager has to decide what costs are relevant, what costs are irrelevant. To have an effective process or efficient process in its decision making. So that's the idea in this objective 6, and we're going to learn that how to describe costs that are relevant and irrelevant in for decision making. The first classification is we can always classify the cost into two categories. One is a controllable cost category. The second one is uncontrollable cost category. So in the controllable cost category, basically the management can influence or change the cost. So for instance, the salaries, the manager can decide how much he or she is going to pay the newly hired employees. Of course, it's basically the negotiation result, but most likely the manager can control the salary expenses. So apparently the salary expenses to me are controllable costs. But when it comes to the uncontrollable cost, there are also many examples. For example, property tax. So the manager cannot influence the property taxes, because practically property taxes are decided by the local governments, right? So the manager has to respect that and cannot argue, cannot pay late. So that's actually a very good example of uncontrollable cost. So this is definitely interesting subject. So you may see some exercises in your online quizzes, and make sure that you can tell what costs are controllable or uncontrollable. So the next classification is relevant and irrelevant costs. So some costs actually are relevant in decision making. So differential costs. Differential costs, which are costs that differ between alternatives. For example, this manager needs to purchase raw materials. So there are say 3 different suppliers, supplier A, B, and C. They all sell the same quality raw materials. Keep one thing in mind: same quality raw materials. And they all have good reputations in customer service and all kinds of things. So now the manager has to decide which supplier he or she is going to buy the raw materials from. So that's a very important decision. So how the manager is going to evaluate. So the manager may think about, so which supplies charges the least in the raw materials cost. So that can be actually relevant. So the raw materials purchase cost might be important in the decision making, and definitely is relevant. So the second category in this classification is irrelevant cost category. So what costs are irrelevant in the decision making? So this is kind of interesting again. So let's come to the raw materials purchase part. So this manager needs to decide from which supplier he or she is going to buy raw materials. So do you think that the property tax payments, the property tax expenses will influence the decision making? Actually, will be important in the decision making? Probably not, because regardless from which supplier the manager is going to buy the raw materials, the manager still has to pay the same amount of property taxes to the local governments. So the property tax expenses are really irrelevant in the decision making on where to buy the raw materials. We can tell that. So there are many other examples like that. For example, the machine maintenance, and maybe the depreciation expenses. So they are all irrelevant to the decision making, to the decision on where to buy the raw materials. Okay, and also we call sometimes there's so-called a sunk cost, the cost incurred in the past that cannot be changed. Okay, so for example here, the manager bought a building, okay, for manufacturing 5 years ago. Okay, so it cost about $5 million US to buy that building, okay, 5 years ago. So now the manager needs to decide, okay, should the manager buy new equipment and machines to put inside that building. So you definitely can see that. So how much you pay for getting to buying that piece of property, land property, the building, that cost has nothing to do with the decision that if the manager is going to buy new equipment, new machines, and put that into the building. So basically, the cost of buying this, the commercial property, the factory, the building, is a sunk cost. It has nothing to do in the decision making. So therefore, the cost of buying this building is irrelevant in this decision making. So that's sort of idea of relevant and irrelevant cost. So this is a very short learning objective. So now let's come to the objective 7. This is actually a very important subject. So we need to classify the cost as a fixed or variable. And also we better know how to calculate the total and average cost at different volumes. So first, let's take a look at the variable cost and the fixed cost and how we define them. So we actually classify the cost into the variable cost category and the fixed cost category based on their cost behavior, Okay, so let's assume that you have a certain cost. If you change the volume, in your activity, so for example, you provide more services, you sell more products, then you see that the change in total cost, in that cost, is actually is directly proportional to the changes in the volume. Okay, so then if that happens, we would say that that cost is a variable cost. Okay, the second category is about a fixed cost. So within a certain level, within a certain level range, for example, when you manufacture products from 0 units to 1 million units, some costs stay constant in total. Okay, so if that happens, then this particular cost is actually a fixed cost. So that's how we classify those costs. Okay, based on their cost behaviors, we can have a variable cost, we can have a fixed cost. So let's take a look at this particular example here. So let's assume that we pay 5% of the sales commissions on all sales. So if you're a salesperson, then that's how you make your income. So if you have income, your salary, whatever, you are paid based on 5% and the total sales. So you multiply 5% of your total sales. That's how you receive the commission salary, or maybe commission payments. So the cost of sales commissions increases proportionally with increase in the sales. Okay, so whenever you have an additional dollar in sales, you will earn 5 cents additionally. Okay, so that's kind of idea here. So apparently, if you try a few numbers, you try a 10,000 sales, you try the $10,000 sales, you try the $20,000 sales, and so on, you can easily find out, you can easily determine the cost of sales commissions, and you plot these values. Okay, you plot the total sales commissions against total sales. Graphically, you will get a straight line, and this straight line has a positive slope. Okay, positive slope. Okay, the slope is basically the 5%. That's the ratio here. Okay, that's the ratio here. And clearly, the sales commission cost, the sales commissions cost, is a variable cost. So actually, there are many examples of variable cost in the real business world. So let's take a look at manufacturing, examples. So let's assume that you are the owner of automobile companies. Then you can see that the cost of tires installed in the vehicles increases proportionally with the increases in the vehicles you have manufactured. So if you manufacture, say, 1,000 cars, then you need 4,000 tires. So if the cost per tire is fixed, then you multiply 4,000 tires by the cost. Then that's how you find the cost of all the tires installed in these the 1,000 vehicles. If you manufacture only 10 vehicles, let's use a small number, okay, 10 vehicles, then you only need 40 tires. Then you multiply 40 tires by the cost per tire. That's how you find out the cost of all the tires installed in the 10 vehicles. So you can play with the numbers, and I'm pretty sure that eventually you will see that the cost of the tires installed, increases proportionally with the increases in the cars manufactured. So the cost of tires is actually is a variable cost, and we consider that's direct materials. Indeed, many direct material costs are variable cost, and also many direct labor costs are also variable costs. So there are many examples like that. So now let's take a look at the total fixed cost. Okay, the next subject, total fixed cost. So basically, there are some costs, they stay constant in total over a wide range of activity levels. Okay, so let's assume that different from the previous example, you are going to pay the salespersons a fixed salary. You are not going to pay them based on their sales commissions. Let's take a look at one extreme situation. So let's assume that this salesperson cannot sell any single product, but because of the contract, you still have to pay this salesperson salary of, say, 50,000 a year. Okay, so if that's the case, then the salary expense of this salesperson is a fixed cost. So like in this case, so regardless, the total, the dollar amount of total sales, 0, 10,000, 20,000, or 40,000 US dollars, and these sales commissions actually stay constant. It's always 2,000. Okay, in this case, the sales commissions that's structured in this example, in this particular case, actually is fixed cost. Alright, so next let's take a look at this particular example here. So how we can find the total cost. So the total cost consists of a fixed cost and a variable cost. Okay, so in this case we can take a look at, alright, so the formula is pretty simple. The formula is total cost equal fixed cost plus the total variable cost. Then the total variable cost here is variable cost per unit multiplied by the number of units. So in this case, the total fixed cost equal 20,000 US dollars. Then the variable cost per unit is $50 per unit, and there are about 100 units in this business activity. Then the total cost is going to be 20,000 plus the $50 multiplied by 100. Okay, so $50 times 100 is 5,000. So the total cost is about 25,000. Okay, so that's how you find the total cost. I think this example is particularly easy for all of us. So you have a fixed cost component. You have also variable cost component. The fixed cost component is relatively easy. The variable cost component is you have to do one-step multiplication. You have to have a variable cost per unit multiplied by the number of units. Then together you will have the total cost. Okay. So the next one is about the average cost. So it's basically you divide the total cost by the number of units, then you find the average cost. Okay, average cost. So for instance, you have say 25,000 units. Okay, if you go back to the previous example, okay, we have 25,000 units in this particular activity. Then we can divide the 25,000 by 100 units, which is sitting here. So you can see that if we divide, I think there is a shift line here. Let me move this here. Sorry. So if you divide 25,000 by 100 units, you can get that the average cost per unit. Okay, the average cost per unit. Sorry, I need the average cost per unit is sorry, I should not have S. The average cost per unit is $250. So that's how I find the average cost. Okay. So you probably don't want to use the average cost per unit to predict the total cost at different levels of output. It's very dangerous because of this average cost consists of average variable cost per unit and average fixed cost per unit. So the variable cost per unit is constant, we know that. However, the fixed cost per unit is not constant. So actually the fixed cost per unit changes at different levels of output. So you don't want to use actually fixed cost per unit to predict the total cost. It's too dangerous. Okay, so therefore this basically the argument here is if you have a very average cost per unit, you probably don't want to assume that this average cost per unit remains constant when you have a different level of output. So don't do that. Okay, don't do that. It's very dangerous. You still have to go back to the original questions. What is fixed cost and what is variable cost? Okay, what is variable cost? And use the original information instead of mixed information to make predictions. Okay. So the next concept is a marginal cost. It's very simple. It's basically the cost of making one more unit. The cost of making one more unit. Okay. So in the previous example, if you go back to in this case that if this is about manufacturing cost, then I would say the marginal cost is the $50 because the fixed cost remain constant even you increase your production by one more unit. So the only additional cost we have here is variable cost per unit. So it's $50. It's $50. Okay. So therefore, in this case, I would say that okay in the previous example here, and the marginal cost is $50. Okay, so basically you make one more unit, all you have to pay is variable cost. The fixed cost will have no increment because fixed costs remain constant over a wide range of output. So even you have a manufacturer say additional 5 units or 10 units, the fixed cost might remain constant still. Okay, if that's the case, then you only have to deal with the variable cost. Okay, so in this case, the cost of making one more unit is $50. Okay, which is essentially okay the variable cost per unit. Alright, so we have just finished chapter 2, and I hope you enjoyed this chapter. And keep one thing in mind, this chapter is particularly important and difficult technical. So make sure that you spend enough time reviewing class lectures as well as online quiz questions. Feel free to visit my office or maybe shoot me an email if you have any questions in the lectures or in the questions. Alright, so that's it. I will talk to you guys next time. Thank you very much.